You're listening to Uranium Spotlight on Tuesday, June 24th, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, uranium market tightens as utility spot buying rises. Niger nationalizes an Orano mine, and equities notch a record-breaking 11-week rally. The uranium spot market surged to $76.50 a pound last week, jumping $6 from the previous week's close of $70.50. It's the strongest weekly gain we've seen in months and came on the back of real volume. The driver? SPUT Physical Uranium Trust. SPUT closed a fresh financing and promptly returned to the market with significant purchases. That activity sparked a wave of follow-on deals late in the week, pushing the spot price sharply higher. Now it's important to understand what this move does and doesn't tell us. This was not a reflection of new utility contracting. It's not a sign that utilities are suddenly paying up in the spot market. What we're seeing is financial demand. Investor capital being converted into physical uranium and taken off the market. That still matters. SPUT's activity reduces available near-term supply and reinforces the scarcity thesis. But the term price, which utilities care about, remains stable around $80 a pound, and there's no immediate sign of a utility rush. Meanwhile, macro demand signals remain strong. China's nuclear fleet expansion continues, and France just greenlit construction of up to 14 new reactors. For investors, this kind of spot action can move equities, especially juniors. But it's essential to understand the source of the move. This was fund-driven, not fuel buyer-driven. The difference matters. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on Purepoint Uranium's YouTube channel. UXC has released its second quarter spot uranium market update, and it paints a picture of a market that's regained strength over the past 3 months. The spot price rebounded from $63.45 a pound in February to $67.35 by the end of April, and then climbed further to $70.90 by the end of May. The report attributes this recovery to a mix of production challenges, newly imposed U.S. tariffs, and ongoing geopolitical uncertainty. While spot market activity remains unpredictable month to month, UXC expects utilities to lean more heavily on spot purchases in the near term, particularly while prices are seen as relatively low. More long-term contracting is anticipated later this year. According to the report, the spot market has swung between surges in buying and selling, but overall the market remains tighter than it has historically been. UXC warns that volatility could return quickly, especially if demand ramps up and sellers begin restocking inventories. We've already seen that when the spot price drops below $70, utility interest returned. In fact, utilities have bought more uranium on the spot market this year than in all of 2024. That shift has helped reduce uncovered utility requirements, while term contracting has continued at a steady pace. Sanctions could further tighten the market. New measures against Russian uranium are currently being discussed in both the U.S. and the EU. As of the end of May, total uranium demand in 2025 is running ahead of last year, 21.5 million pounds sold so far, compared to 20 million at the same point last year. Utility purchases drove most of that increase, rising from 2.4 million pounds in the first 5 months of the last year to 8.7 million this year. Traders also stepped up, buying 7.5 million pounds so far in 2025, up from 6.2 million last year. However, demand from producers has fallen sharply, from 3.9 million pounds last year to just 0.9 million in the same period this year. Financial players have also reduced their purchases by nearly half, down to 3.6 million pounds. Looking ahead, UXC expects between 8 and 14 million pounds of demand from June through August, compared to 9.2 million during the same period last year, as some utilities may try to get ahead of the fall buying season during what's typically a quiet summer market. On the supply side, things are relatively muted. Orano began development on a new ISR project in Uzbekistan that could eventually produce 1.82 million pounds annually. Kazatomprom secured financing for its long-awaited sulfuric acid plant. and a Swiss fertilizer firm is planning another plant to help resolve Kazatomprom's reagent supply issues. Meanwhile, the U.S. is now on track to produce roughly 1 million pounds this year from the White Mesa Mill. That said, in our view, these new developments, while notable, represent small and mostly future contributions to global supply. They're unlikely to offset rising demand, especially as we head into the fall. UXC's outlook highlights the potential for renewed volatility in the months ahead. Summer may bring a seasonal dip in buying, and with it some downward price pressure. But if the U.S. proceeds with its proposed nuclear fuel sanctions on Russia, including a 500% tariff on Russian material, that could place major upward pressure on prices. More importantly, demand continues to grow, yet no significant new production is scheduled to come online before 2026, aside from White Mesa. And even that won't be enough to meaningfully close the gap. For investors, the takeaway is clear. The uranium market remains structurally tight, with prices supported by rising demand, limited near-term supply growth, and intensifying geopolitical risks. If current trends hold or accelerate, there's a real case for continued upward pressure on uranium equities as the market adjusts. Last week, Niger's military government announced the nationalization of Orano's Somer uranium mine. According to the government, Orano breached its shareholder agreement by producing more than the 63.4% stake it was entitled to. They also accused the company of pulling its French personnel from site, halting operations, and at one point attempting to sell off the mine. This is part of a broader pattern we're seeing across West Africa. Following recent coups in Niger, Burkina Faso, and Mali, there have been multiple government takeovers of resource assets. It's a sign of just how geopolitical and volatile the competition for critical minerals like uranium has become. Both East and West are vying for control as they scale up nuclear power and secure long-term supply chains. Orano, for its part, says it tried to resolve the matter through dialogue but received no response from the junta. They're now pursuing legal actions, with 3 lawsuits already filed against the Nigerian government in international courts. This isn't an isolated story. It's a microcosm of what's playing out globally. China and Russia continue to ramp up uranium purchases from Kazakhstan. Western nations are phasing out Russian nuclear fuel. And behind it all is a growing recognition that uranium supply is increasingly shaped by geopolitics, not just geology. For investors, this underscores a key reality. Jurisdictional risk is real and rising. As resource nationalism escalates and East-West energy competition intensifies, secure, stable uranium production in politically reliable regions will command a premium. Uranium equities just marked an 11th straight week of gains, the longest winning streak the sector has ever seen. That alone should catch the attention of any resource investor. What we're seeing isn't just a speculative pop. It's a structural shift that's been building for some time. Last week, the Global X Uranium ETF hit a new 52-week high, more than doubling from its lows just a year ago. That kind of move in an ETF reflects broad-based buying and growing institutional interest. What's driving it? A mix of real fundamentals and renewed investor focus. On the demand side, global utilities are increasingly locking in long-term supply as nuclear reclaims its place in energy security planning. Add to that the rise of AI and data centers, massive power consumers that are pushing grid reliability and decarbonization to the top of the agenda. Nuclear is one of the few scalable non-intermittent solutions. Meanwhile, on the supply side, new production remains constrained. Development timelines are long, costs are rising, and many of the sector's new promising projects are still years away from delivering pounds. Put it all together, and it's no surprise that companies like Cameco and NextGen have seen significant appreciation. But this rally also signals something broader. Uranium is no longer an overlooked corner of the market. It's drawing mainstream capital, policy support, and serious momentum. Whether this run continues or pauses, it's clear the uranium sector has entered a new phase, one where energy transition, geopolitical relevance, and investment flows are all converging. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.